in line with one of our core fundamental research views, core PPI appears to be bottoming at a level that is inconsistent with the structural mean of 2% inflation. So this is one of the charts we've been showing as part of the immaculate disinflation theme that's been underpinning our bullish views generally for the past a little bit over a year now. We pivoted to transitory Goldilocks back in January of 2023. So immaculate disinflation is one of those themes that's been supportive of transitory Goldilocks, or really just Goldilocks in general, because obviously that's what's happened in asset markets, at least over the past few months. But in terms of core PPI, so it's been leading the decline in core CPI and core PC deflator. These things have a little bit more stickiness in terms of in terms of the index constructions and methodologies, the baskets, et cetera. And core PPI has been a little bit more of a cleaner read on what's actually happening from the perspective of inflation, which is why it's been a leading indicator. Well, it looks like it just bottomed. Well, if it bottomed it, okay, let's call it 2%. That bottom is inconsistent with the kinds of bottoms you need to create an average of 2%. You can cycle around that to create an average of 2%, but if you bottom at 2%, that's going to be a problem. And this is something we've called out very explicitly in the left tail risk section of our macro Scott reports for a while now, vis-a-vis our Hope plus I framework analysis, vis-a-vis our recession analysis, in terms of understanding that you tend not to see these kinds of very positive inflation outcomes prior to recession. So we understood that immaculate disinflation is just that. It is immaculate. It is something that does not typically happen. So we understand that it's probably going to end before we want it to end as investors. That's the highest probability outcome. And so we still think the black line and the red line in this chart have some time space to go down over the, let's call it the next 1 to 2 quarters. But, looking out 3 or 4 quarters, we expect those black lines and red lines to bottom at a level that's inconsistent with 2% inflation let's call it in 2, 3, 4 quarters. So in our opinion, that's going to create a problem for asset markets down the road. It doesn't necessarily need to create a problem for asset markets today.